Talk about the headline that caught everyone's attention. The Dow didn't creep over 50,000, but it did push above it at last. On Friday, it leaped. After a tough patch, there was a quick bounce. It's the kind of maneuver that, in around 10 minutes, turns folks from doom scrolling to chest puffing, about 2.5% in a single session. 100 points or such. Suddenly, a psychological ceiling became a topic of conversation. Now, with a milestone like this, I also want to talk about the nostalgia trap. Because people start looking up previous forecasts whenever the Dow releases a fresh, large round figure. You recall the atmosphere. This is where the Dow is heading. The Dow is heading there. The new era has begun. It's also enjoyable, but it may influence your choices. Back in the early 2000s, there was a well-known wave of optimistic literature that essentially maintained that the Dow was drastically undervalued and that a massive upside objective was imminent. Soon, but not someday. In actuality, it took a lot longer and involved a very unsightly journey until the market finally arrived. That's just me being realistic, not being pessimistic. You're essentially offering to buy at the peak of a hype cycle if you're the kind of person who reads a bold forecast and then makes a purchase when everyone else is celebrating. Additionally, you are essentially offering to sell the bottom of a fear cycle if you are the kind of person who sees a scary headline and sells the instant everyone is in a panic. Therefore, I don't view 50,000 as a goal. It's a mirror. The extent of sentiment's expansion is reflected in it, and if the liquidity and fundamentals can sustain that stretch is the only thing that counts. The Dow didn't get to this level by chance, which is why I'm saying this. It got there because the most of the work is still being done by a small group of megap names. Additionally, the indexes appear impenetrable when those names are green. However, I would like you to consider this subject for a moment. Was the motion a release valve or a show of strength? Because those two things are not the same. Even in the absence of applause, strength is a tendency that persists. When positioning becomes too unbalanced and the market pulls back to catch its breath, it creates a release valve. And when you zoom out and look at what happened today, Monday, you can definitely feel that tension. The Dow did not lead, but it did hold the large figure. It was the Nasdaq. So did the broad index. The Dow essentially tiptoed to another record close, but tech was the engine once more. That's a clue, but not always a sign of bearishness. It informs you that a limited number of names and themes continue to dominate the industry, not by a broad, healthful upsurge in all areas. To avoid making this a laundry list, let me give you a brief overview of what that looked like today. The broad index and the Nasdaq appeared healthier than the Dow's small advance would imply, thanks to a few big software and platform firms that popped hard on upgrades and headline relief. However, it wasn't a landslide even among the so-called mega cap club. A few of those giants were red, but several were higher, indicating that the market is still selecting its spots rather than making rash purchases. I continually returning to the basket view because of this. You can sense how different this market is from a real broad-based bull run if you follow the top 7 megap growth names as a single transaction. Because it pulls retirement accounts upward and keeps the headlines positive, a rising basket might give the impression that everything is safe. The rest of the market, meanwhile, begins to feel as though it is walking on a cracked sidewalk when that basket is choppy. Here's a subtlety that most people overlook. A basket may be in a bull market even if it is close to the bottom end of its recent range. It is unsafe even if it is not collapsing. Occasionally, the risk is as simple as the market becoming a single trade and that trade ceasing to trend. Therefore, I'm not advising you to freak out if you've been riding that wave. I'm advising you to be mindful of the potential for leadership to shift away from the most well-known individuals. And if that occurs, your portfolio may feel like it was struck by a truck, but the indices may appear okay. Let's take a moment to discuss Tesla while we're here, as it's a prime illustration of how headlines and price movement can diverge. Even although Tesla is up for the day, it is still directly above a support zone, which, if it breaks, will completely alter the situation. That does not imply that it will shatter. It simply indicates that it's one of those charts where you don't want to act as though you're blind to the line. Now, you can see why I don't agree with the everything is great camp, even though the tape is green, when you combine that type of chart fragility with a Dow at 50,000. The exciting element is that everyone wants to add a narrative to that. The new economy is it. The AI wave is here. Rate cuts are on the horizon. Although those tales may have some truth to them, the market rarely provides a single clear explanation. It resembles a sloppy drink more. Let's dissect that cocktail in a way that will benefit you. Because having opinions doesn't get you paid if you're trying to make money. You are compensated for anticipating the setting and controlling your risk as it changes. The rebound trade is the first component. Many short-term funds were tilting in one direction after a number of unpleasant sessions. People cover and chase when it stops working, and the tape appears to be a miracle. We've all witnessed it. Headline leadership is the second ingredient. Similar to how a large truck pulls a little trailer, one or two heavyweights can pull an index. The market as a whole doesn't have to rally. To stop falling and begin climbing, all you need are the largest weights. And that's exactly what happened on Friday, driven by a few of the typical suspects who have the ability to move entire indexes when they spot an offer. The Fed flinching trade is the third ingredient. It's evident in the way dealers speak. The way yields move gives you a sense of it, and the manner that gold and silver are refusing to stay down is a clear indication of it. And because that's where the story gets heated, I'll get to the metals in a moment. I want to briefly discuss the stock internals before we go there though, as they help to explain why this move appears solid on the surface but feels vulnerable on the inside. You had a lot of the same intensity on the winning side. Chips, cloud, and big data are the items that have become the comfort food of the market. And on Monday, you witnessed it once more, with technology taking the lead and even the information technology sector of the overall market occupying the top spot. It's not that everything is falling apart on the losing side. The problem is that the weak points remain the same. A large retailer may fail. One stock may appear to have been thrown off a cliff when a massive cap guides lower. That's nothing new. The market's rapid shift from, "I love this," to, "I can't own this," with little to no notice, is what's new. Here is my first query for your comments. Is a Dow above 50,000 a cause for celebration or a sign that prices have strayed too far from reality, in your opinion? I'd like to know your thoughts on it. And take a look at cryptocurrency if you want a fast reality check on how erratic your risk appetite still is. In an instant, Bitcoin may shift from quiet to turmoil. And the ideal illustration was last Friday. After dropping heavily and then bouncing back, it was essentially acting as if nothing had happened by Monday. A sluggish, stable market would not act in such a manner. It is the way a market behaves when there is a lot of liquidity but little confidence. Therefore, when positioning becomes crowded, the price can change quickly. I mention that because high-growth stocks, silver, and even the currency are all exhibiting the same psychology at the moment. Individuals are trading stories quickly rather than establishing long-term positions slowly. Let's turn our attention to currencies now, as they serve as the background that subtly influences everything else. Many individuals view the decline in the US dollar as a scorecard. Stocks rise as the dollar declines and risk increases. That is true sometimes. However, it can also be a sign of something more serious, such as a shift in confidence from holding cash to holding anything else. And it first appears in strange places when that begins to occur. The dollar index is one of those locations. Additionally, it has been slipping on days when you would think it would receive a bid and sitting in the mid-90s lately. Even though markets were up and volatility was still present on Monday, it was down nearly 1%. You may now compare the dollar to a more secure currency and draw a similar conclusion. For extended periods, the dollar has struggled to compete with currencies that are perceived as dull, steady, and disciplined. Additionally, you're not incorrect before someone jumps in and says, "Yeah, but every currency gets printed." It's not about being flawless. The issue is one of relative trust. In a dirty league, it's about who appears to be playing the cleanest game. This is the point at which I will question a widely held belief. Many people discuss dollar weakening as if it signifies that the US is collapsing. As a generalization, I don't believe that. Even with a weak dollar, the US can still be the destination for international capital when panic strikes. We have repeatedly observed such pattern. Therefore, whether the dollar is weak is not the fundamental question. The fundamental question is whether the dollar still receives the first call when terror strikes, because the entire chessboard changes if it doesn't. That brings us directly to metals. Gold has been behaving as though it has a destination. It continues to find buyers and, like a magnet, keeps going back to the 5,000 zone even after strong pullbacks. Gold futures were up sharply on Monday, clearly not acting like a finished asset, but still far below the late January peak. This is the part that many miss. It's more than simply gold, it's silver. It's also worth noting that silver has been even more sentimental than gold. In a single session, silver can transform from hero to villain, and on Monday, he can return to his former role. Even the spike in silver futures was a recovery from a considerably greater top that was set in late January. Additionally, since silver is more than just a financial tale, I would like to make a statement about it that is unrelated to vault charts. Silver is a tale of industry. It is found in electronics, it can be found in medical equipment, solar panels contain it, and the wiring that powers modern life contains it. The demand for electrification themes has been increasing over the past few years. Furthermore, those industries don't simply disappear overnight, especially in times of economic slowdown. When possible, they substitute, slow down, and adapt. However, silver tends to remain on the buying list. Because of this, silver does not act as a serene store of value as many think gold does. It has hybrid behavior. When growth is the focus, it can trade like a risk asset. When currency confidence is the focus, it can trade like a monetary hedge. And you get the powerful emotional movements that we've been witnessing when both stories are told simultaneously. Therefore, don't choose one story and marry it if you're wanting to grasp silver. Consider it a complex animal. When you get arrogant, it bites, and when you respect its nature, it rewards you. The why is important here, so if you're watching this and thinking, okay, metals are up, that's all I need to know, slow down. There are two ways to answer this: physical demand and paper trading. Usually, those two lanes move in tandem. However, when they split apart, you can find hints that a chart cannot provide. This leads us to the specific detail that keeps cropping up in my remarks: the premium paid abroad. Particularly in Asia, there have been periods when physical silver traded outside of the US is markedly higher than the US benchmark price. The market is essentially telling you that the metal in your hands is being handled differently than the metal on a screen when that premium increases. That's not nothing, but it also doesn't mean that anything noteworthy will occur next. Additionally, the Asia side exchanges have been coping with their own version of the frenzy, which is one reason why the premium discourse abroad has been becoming louder. In an effort to calm things down, Chinese metals exchanges have recently increased margins and tightened regulations on many occasions for the entire metals complex, not simply gold and silver. Stepping in repeatedly during an encounter is essentially acknowledging that the crowd is pushing too hard too quickly. Although it doesn't reveal the final price, it does indicate that there is a high demand to join. Let's now discuss the intersection of the physical lane and the paper lane. Data from the exchange vault. People become emotional at this point, thus, let's maintain its groundedness. Silver inventory is divided into buckets on the exchange, and when it comes to delivery, one bucket is more important than the others. Lately, the delivered bucket has been somewhat over 100 million ounces. Even while the larger bucket, the eligible category, is substantially greater, nearer 300 million ounces, it is not necessarily available. It just indicates that it is in authorized storage and satisfies the specifications. The temptation now is to shout deficit as soon as you see that deliverable figure. However, this isn't how it operates. For causes unrelated to the complete metal missing, the deliverable bucket may rise or decline. Occasionally it lowers because owners would rather hold on to metal in an eligible state until they receive a sufficient payment to justify conversion. Occasionally, it rises as a result of a holder moving metal into deliverable status after spotting an opportunity. Therefore, the deliverable line cannot be compared to your car's fuel gauge. It resembles a filled arena's seating chart more. Even though the building is packed with seats, not all of them are available for purchase at the same price, and not all of the holders are interested in moving. However, incentives have been changing lately, which is why this is important. The incentive to keep metal off limits may now wane as volatility soars and the market begins to pay more for immediacy. However, its deterioration is not uniform. In spurts, it becomes weaker, and the frightening days are precisely caused by those explosions, days when, despite the fact that overall stocks still appear to be high, the market feels as though it is running out of stock. Therefore, avoid clicking on clickbait when you encounter headlines like, "The vaults are empty." In absolute terms, the total stockpile remains enormous. However, during a delivery window, the deliverable part is the one that may matter. And while interest in silver has been soaring, that fraction has been sliding lower. This is where things start to get interesting since the exchange itself has been reacting to how quickly this move has been made. Due to price volatility, precious metals futures margins have increased once more. In essence, the exchange is saying, we want more collateral because this is getting rowdy. Additionally, when margins increase, forced selling frequently occurs, which can result in abrupt dips that appear to be the end of the trend even when the underlying demand hasn't changed. Here's the twist now. In response to growing retail demand, the exchange is also launching a smaller silver futures contract on this day. That gives them a clear indication of the level of participation they are witnessing. It indicates that big organizations hedging industrial flows aren't the only ones showing interest. Additionally, price action can become much more violent in both directions due to the influence of crowds. What does that signify for the upcoming weeks then? It implies that the market is capable of two opposing actions, both of which would be rational. In the first scenario, the pressure on the paper decreases. Without the metal moving, many open spots are closed, rolled, or settled. That's typical. Futures markets typically operate in this manner, and if that occurs, the frightening math that people share on social media begins to appear far less frightening. In the second scenario, the deliverable bucket keeps getting smaller as the March contract notice date approaches, either because enough participants decide they truly want metal or because they wish to put stress on the system. Even when only a portion of those holdings stand for delivery, the sheer sight of having a large amount of paper left open while the deliverable stock is slipping might cause panic. And I will tell you the truth. The base case, in my opinion, is not a neat default headline. Exchanges have playbooks. Major players have connections. There is a cash settlement. Mechanisms exist. There are more escape routes in the market than most people would want to acknowledge. However, that does not imply that there is no tension. Higher premiums are a sign of stress. Stress manifests as quicker inventory turnover. Increases in margins are a sign of stress. People discussing silver at the dinner table again is a sign of stress, and all of that is now visible to us. Since the notification period begins in late February, the March timeframe is now the one that keeps popping up. You can determine how much of the paper becomes actual demand for bars during that window, which is why it counts. And there will be a lot of gamesmanship between now and then. As traders move forward, large open interest numbers will rapidly decline. Sudden drops will occur, frightening off-late buyers. There will be unexpected increases that entice FOMO purchasers. And you'll read posts like this all the time. This brings me to my second remark query. Do you believe that the physical premium abroad is a true indication of tightness? Or do you believe that it is primarily a mood and logistical story that will subside as soon as the volatility subsides? The delivery velocity we've already observed in recent months is yet another hint that is disregarded. Fireworks in actual deliveries are typically not expected in the early months of the year. Because many industrial flows are hedged on longer schedules and a large amount of speculative money is holding out for the spring, it is typically calmer. However, the delivery figures have been exceeding expectations in recent times. In fact, a remarkably high percentage of contracts turned into delivered metal in January. And even in the midst of a hectic month, February got off to an aggressive start. Once more, I'm not advocating panic. I'm telling you to listen. Open interest can appear enormous and still be harmless when delivery are minimal. However, you begin to understand why so many people are keeping a close eye on the late February notice window as if it were a countdown clock when you see a March contract that still has a significant amount of paper exposure open after deliveries are already hot. And this is where the psychology becomes risky because the crowd begins acting in a way that attempts to impose the squeeze as soon as they think it is unavoidable. Even if the market eventually cools, it might make the story self-fulfilling for a while, tighten availability in the short term, and inflate pricing. Therefore, you need exercise caution to avoid being a pawn in someone else's game. Purchase physical goods because you genuinely want the metal. Instead of trading paper because you're looking for a headline to save you, trade because you have a plan and risk management. Now, while everyone is obsessed with silver, keep in mind that the larger macro is also driving this entire narrative. One factor contributing to the bid in growth companies was the slight decline in bond yields. The market's attempt to predict Monday's next policy shift, however, is the main cause. The yield on the 10-year was just over 4%. Additionally, current policy assumptions are disorganized. On the one hand, some indicators continue to show that growth is still lingering and that inflation has not been defeated. However, there are new indications of stress beneath the surface. Due to disturbances that are postponing important releases, layoff notices have increased, and even basic economic reporting has become more complex. Even if the Fed doesn't want to, traders will eventually be forced to react to that kind of uncertainty. Therefore, the market continues to tilt toward no change when you look at rate probability for the meeting that ends in mid-March. However, the likelihood of a cut has been fluctuating and can quickly rise in response to every fresh news story. And it explains the odd combo you're seeing. Metals are not giving up, stocks are reaching new highs, and the currency is declining. Since most people get confused at this point, let's bring everything together. They believe that everything is okay when they see the Dow above 50,000. They believe that everything is broken when they see gold above $5,000. The truth is that since markets are not a single tale, both may be accurate in the same week. Markets are a collection of conflicting narratives. Finally, for the sake of keeping your head straight, here is some background information. You are frequently observing two sides of the same coin as indexes reach new highs while cash seems weaker. Businesses that are actually expanding can see an increase in asset prices. However, they may also rise as a result of the measuring stick's shrinkage. I therefore keep an eye on spreads, credit, and real-world stress signals in addition to price. Rallies can go much longer than anyone anticipates if those remain composed. The headline highs become traps if they break. Remain patient and vigilant. This is the story that I believe is most important at the moment. The stock market continues to float on buybacks, liquidity, and the notion that a small number of businesses that can expand under any circumstances will rule the future. Over a lengthy period of time, the belief might be correct. However, it causes instability in the near term because the entire index may sway if just one of those pillars fails. The metal market is acting as a pressure gauge at the same time. It's not making end-of-the-world predictions. It shows that individuals are concerned about the stability of policy and the long-term purchasing power of money. Additionally, that pressure gauge tends to increase the more politicized, ambiguous, or reactionary the policy appears. Here's what I want you to do if you're already positioned and viewing this. Stop tying yourself down to a specific price first. Attach to your strategy. Well done if you purchased equities with long-term compounding in mind. Great if you purchased metals as insurance. However, don't let one violent session make you think your plan was a waste of time. The cost of entry is volatility. Second, consider ranges rather than absolutes. If the Dow can gain 2.5% in a day, it can also fall 2.5% in a day. Silver can slam you down in the next session if it can rip higher in the previous one. Therefore, avoid sizing your holdings as though the market is obligated to you. Thirdly, acknowledge your ignorance. Whether a premium overseas widens again next week, how many contracts will remain for delivery, or how rapidly open interest will roll away are all unknown to us. You manage risk in order to deal with that uncertainty. Fourth, pay attention to the hints rather than the noise. Observe patterns in deliverable inventory. Check to see whether premiums remain high. Check to see whether margin increases continue. Check to see if the dollar continues to decline even when panic arises, and observe if tech leadership continues to be confined or begins to expand, because that's a new market if leadership expands. Additionally, that is a different market if the leadership changes. Before we wind up, there's one more item I want to address directly because it's important. If you're successful, post your success story in the comments so others can keep motivated. Those that are viewing this are attempting to get out of a rut, develop self-control, and cease making rash judgments. It could be your tale that prevents someone from giving up. Okay, so what should we do next? I believe you need to be ready for more chop in the very near future. A busy calendar lies ahead of the market. More data, more earnings, and more conjecture about policy. The coming weeks will be a battle between paper positions and physical reality, especially for silver. The stress story cools if traders continue to roll forward while open interest continues to melt down. The stress story intensifies if it doesn't, and if deliverable stock continues to decline. In any case, it is unlikely to be a smooth ride. Therefore, don't let the large round figures captivate you. 50,000 is a catchphrase. 5,000 is a headline. What occurs when the applause subsides is what counts. Please leave a comment with your thoughts on where you believe the true risk is at the moment, and subscribe if you found this helpful so you don't miss the next update. In a weakening dollar, in overpriced stocks, or in the commodities markets plumbing. This is for educational reasons only, as usual. I'm not suggesting you what to buy or sell, I'm just providing my thoughts on the market. Before making any financial decisions, do your own research, think about your specific circumstances, and, if you need individualized guidance, consult a knowledgeable professional.